while attendees are still dropping in, it is my pleasure to welcome you to our March edition of the Forest Restoration Talks. My name is Gesche Schifferdecker. I'm the comms manager for EFI, and my co-host today is Elisabeth Schatzdorfer. She's the coordinator of the Super project. Today, we will talk about how nature markets can actually work in the 21st century, and we will learn from lessons collected from England, Australia, and the EU. And our guest today, our speaker today is Sophus Ermgassen. He's an ecological economist working on topics broadly related to biodiversity finance, UK environmental policy, biodiversity compensation, like for instance, biodiversity offsetting, biodiversity net gain. He's also working on infrastructure sustainability, exploring nature positive organizations, and he's involved with post-growth economics. A key focus of his current work is on learning lessons from shortcomings in past nature markets to understand how to design nature markets in a way that satisfies both ecological and financial objectives. And that's also something he's exploring in the Superb project, in the work package on sustainable finance. And I also want to mention that he's the host of one of my favorite podcasts called Economics for Rebels. Before I let you speak, Sophus, just some housekeeping rules. The webinar is being recorded, and we will provide the recording afterwards on the EFI YouTube account. So in case you have colleagues or friends who have missed this webinar, you can recommend it to them later. If you have questions to the panelists, please use the dedicated Q&A box. And in case you want to speak also and be part of the panel, we can promote you to become a participant, in the panel, to become a speaker, so that you can ask the question yourself. In case you don't want that, just decline our invite and then I will read the question. Please also follow us on LinkedIn. We have deleted the X button because we're not really active on X anymore for several other reasons, but that's not to be discussed today. Now I'm really happy to hand over to Sophus, and I'm curious to learn from your presentation, and then we can have a nice discussion afterwards. Sophus, you have the floor. You still need to, yeah, perfect. You're unmuted. Great.
Thanks so much for having me. I really appreciate it. Really appreciate the invite. So my name's Sophus Ermgassen. I'm a postdoc based at the University of Oxford. I'm part of work package 4 of the Superb project, which is all about sustainable finance. I've been working in biodiversity and nature markets for about a decade. And for the last 3 years, I've been investigating the barriers, challenges, and opportunities for upscaling private investment in nature in Europe as part of the Superb project. And this presentation is an accumulation of quite a lot of the thinking from work package 4. I've been doing evaluating the outcomes of nature markets across a lot of jurisdictions for the last 7 years or so. And from this, I think we are now able to derive generalizable lessons about how to make nature markets work. So I actually think that this is an issue that is debated a huge amount politically, and it's often debated as if there are some kind of there are irreconcilable issues at the heart of nature markets that means that they can never be perfect or scientifically credible. But I'm going to try and convince you that actually we can precisely define them. We can study them scientifically, and we actually have, in my view, about 30 years of evidence about how to make them effective or not. And what I'll ultimately conclude is that the limitations to nature markets are not really scientific, but they're fundamentally political. And nature markets are often a policy solution that is used as if it's a kind of alternative to direct public policy or direct the delivery of conservation by states. And what I'll try and convince you is that I think that's total rubbish. That's a false dichotomy, and that if you want nature markets to work, they actually need a huge amount of state investment and state governance to work. And so I actually think that it's a false dichotomy, and it is actually not so much to choose between sort of direct state conservation and market-based state conservation. And in many cases, I actually think it's likely that direct state conservation might be more effective than market-based conservation. But I'll get on to where I think that the next questions are in this scientific literature towards the end of this. Okay, so let's start here. I'm going to talk to you about, there are many tens of different nature markets all around the world, and they all are, they all do slightly different things, measure biodiversity in different ways, are organized around different kind of governance architectures. So on the left-hand side, in the summer of 2019, I went out to Victoria in Australia, which has one of the world's most famous, oldest, and sort of best regarded biodiversity offset markets. And I was working at RMIT in Melbourne at the time, and I was going on field work to go and study offsets delivered through Victoria's state offsetting system. So I rented a car and I drove 700 kilometers one way to reach a site. And I was really excited. I thought I was going to see some kind of super bit of native temperate woodland that I thought, otherwise unprotected, valuable ecological community that the nature market can help bring under protection. And I arrived at the site after 700 kilometers, and I arrived to a picture that looks a little bit like that picture on the left-hand side. So basically a degraded pasture, a few cows on it, and some isolated tree fragments. And I thought, this can't be it. Right, this can't be the offset, the output of this nature market, but it was. And then we spent the day going out there and measuring the trees, the diameter of the trunks of the trees on this degraded pasture. And I remember just thinking, this is really rubbish. And I turned to the environmental consultant who was with me, and I said, this can't be it. And he leaned back against the tree and he said to me, Sophus, I think this is going to get a lot of powerful owl credits. Now, I was like, that's kind of absurd. So this kind of like degraded pasture with some isolated tree fragments it's going to get lots of credits for being valuable habitat for a specific protected species that we haven't even seen on the site. So this got me thinking, what is it about the specific way that this policy measures biodiversity, the governance underpinning it, that means that this thing counts as good and counts like it has market value, whereas other natures, don't? Now, let's contrast this with on the right-hand side, in the summer of 2022, this absolutely beautiful field visit to another basically offset. So another type of market-based conservation in England. This is a nature reserve called Chimney Meadows Nature Reserve in Oxfordshire. And it's a beautiful sort of quintessential English nature reserve. There's a little bit of river restoration, a little bit of barrier removal. They purchased some unproductive farmland from a farmer and essentially have managed it for nature. It's now abundant wildlife. When I was there, it was a beautiful summer's day and the air was kind of humming with insects. So what is it about that specific set of institutions and markets that leads to that outcome here, right? So that's what my studies do. I try and investigate the outcomes of these nature markets and market-based instruments across the world and link their outcomes to the way that they're designed and their governance. And we try and provide scientific recommendations about how to make these things better. Now, for context, this is the kind of overarching framing. It's not actually a framing I like, but it's a framing that's easy, so I'm going to use it here, is the idea of the global biodiversity funding gap. The idea is that biodiversity does not receive enough investment, and if we increase investment in biodiversity, then we can achieve the funding goals embedded in things like the post-2020 global biodiversity framework. So this figure here is from a very famous assessment of the global biodiversity funding gap. It suggests that we need to upscale investment in nature by a factor of 5 to 7 to achieve the goals in the Kunming-Montreal Agreement. And it makes some incredibly ambitious, optimistic projections about how we might do this. So you notice that the bottom green chart there, they suggest that we might be able to upscale biodiversity offsetting by around $200 billion per year by the year 2030, all these kind of things. So it adds up how we potentially can raise more investment in nature. The other thing that this graph does quite nicely, I think, is it shows that biodiversity finance is an umbrella term that covers a lot of stuff. But by far the most important thing that we can do for biodiversity finance right now is to stop perverse subsidies that cause nature degradation. So there's a huge amount of public finance that is going into destroying nature already. And a big chunk of the problem is reducing harmful or damaging public finance. So I actually study how to upscale private finance, but I want to make it very clear right from the start that I think this is a tiny part of the overall solution of achieving overall biodiversity funding goals. By far the most important thing that we can do is to regulate private finance so that it is no longer profitable to deliver economic activities that harm nature, and also to downscale perverse subsidies so that we, as European taxpayers, spend less money on actively destroying or subsidizing the destruction of nature. So those are the two most important bits of the puzzle, but my talk is about this tiny slice, which is upscaling private investment. Now, there is a lot of policy momentum behind the idea of upscaling private investment in nature right now. So this is a table from a paper that we've just published, which I'll get onto later. But in short, it just shows that there are lots of potential drivers of investment in nature. These extend all the way from the highest level. There are explicit targets in the Kunming-Montreal Agreement. For example, we've committed to raising at least $200 billion per year for investment in nature, predominantly through private finance, through leveraging private finance, promoting blended finance, and stimulating innovative schemes such as payment for ecosystem services, green bonds, biodiversity offsets, and biodiversity credits. So those are targets that are explicitly embedded in the Kunming-Montreal Agreement. What I find really crazy and interesting about this is that at the time that this was embedded into our global policy for delivering biodiversity conservation, biodiversity credits didn't even really exist yet, and yet they were explicitly included in the Kunming-Montreal Agreement. Right? Then you've got these kind of other drivers that are mostly targeting businesses, with the idea that businesses should disclose more about their environmental impacts, and several of these mechanisms include avenues for reporting businesses' positive contributions to biodiversity conservation as well, alongside their exposure to risks or their impacts. So these include frameworks like the Task Force for Nature-Related Financial Disclosure, or before the EU Omnibus, the Corporate Sustainability Reporting Directive. So various initiatives that are seen to potentially increase the appetite for private investment in order to meet firms' reporting obligations. And then at the national level as well, lots of individual case studies in countries are going ahead with some of their own domestic markets. So one incredibly ambitious domestic policy framework is England's Nature Market Framework, which represents, it's this sort of quiet, understudied document that is a total revolution, actually, if you read it. But essentially by 2030, they want, the government in the UK wants to generate £1 billion of private investment in nature per year. But the government data from the Joint Nature Conservation Committee shows that England spends, the UK spends somewhere between 600 and 800 million pounds a year on publicly funded conservation. So by 2030, they want to flip the trend, the historical trend for conservation to be mostly publicly funded and move to a predominantly privately funded national conservation regime. That is a completely unprecedented in the whole of human history. As it stands now, according to the United Nations Environment Programme's State of Finance for Nature report, well over 80% of funding or investment in nature is pure state investment. So this is an incredible transformation in governance. Now, this actually is a paper that came out a few weeks ago in Nature and Ecology and Evolution, and I'm going to go through a lot of the analysis towards the later half of this talk. But one of the things we did is an online literature review for national state supported carbon and biodiversity markets across Europe. And this is what we could find. There are limitations to our search that are all in our paper. For example, our team was only able to search in English, so we used online translation softwares to translate our search terms into different European languages. But of course, that's naturally limited in case we got the wrong terminology. But this was the best that we could find on national state-supported biodiversity and carbon offsetting systems. You can see that there's several that are in development across the EU. There are several countries that now have carbon markets, state-supported voluntary carbon markets, and England also has a mandatory biodiversity market. Germany also has their mandatory mitigation regulation where they have these compensation pools. So that's a sort of market-based instrument for delivering nature compensation. So this is how the picture currently looks. This is only for these national state-supported systems. There are also lots and lots of local pilots and also private pilots for different methodologies and standards for these kinds of instruments across Europe, and those are not recorded in this map. So for example, we know there's a lot going on to develop voluntary biodiversity credits for basically for forest management in Sweden, but they wouldn't be recorded on this map because they're not officially state supported. They're a kind of private initiative. Right? So that's what we consider like a state of carbon and biodiversity markets that are affiliated with the state across Europe. Now, what I'm going to do in my talk today is very simply break down a lot of biodiversity finance and a lot of what we've learned in Work Package 4 over the last 3 years. So I'm going to tell you how you can make money from nature, right? And how this is conventionally done when people try and build business models around delivering nature restoration. And then we're going to go through principles for designing scientifically credible nature markets. And we're going to first ask, if you actually pay for a specific environmental outcome, how can you be sure it's real? And then secondly, this incredibly important but often overlooked governance issue. If you buy a specific environmental outcome, can anyone actually check that that thing has been delivered? And if they then discover that it's been non-compliant, can anyone actually do anything about it? So the bit of the governance that underpins these nature markets. And then lastly, it's this work on how you upscale private investment. And what we found is if you want to attract mainstream commercial investment in nature restoration or conservation, that you need to make it deliver the same kinds of risk return ratios as any kind of commercial investment. So basically, in order to attract private investment at scale, you need to make these things as profitable as tech stocks. And I'm going to talk to you about why I think that's unrealistic. And therefore, this whole rhetoric about upscaling private finance for nature conservation is possibly misguided. Okay. So this is just a very simple overall schematic from a recent paper that we did. That's a very simple primer article on how you finance ecosystem restoration. But in short, there's lots of potential different forms of demand, right? You have private investors, corporations who might buy particular services. By far, the largest funder of ecological restoration is national governments, and then you have a philanthropic community as well. And there is lots of different mechanisms for financing nature restoration. These might include direct investments in stuff that delivers operational efficiencies. So we know, for example, there are some large consumer good companies that invest in nature restoration because it reduces their water treatment bills. That is a investment in nature. Insetting, right? These include corporations that might invest in environmental sustainability measures throughout their supply chain because it thinks it improves their business's performance or reduces their exposure to risks. So a classic example here might be a large consumer goods company that invests in climate smart agriculture in tropical commodity supply chains. And they do that partly because it increases yields and partly because it buffers yields against climatic shocks. So it's in the business's own interests to invest in conservation within its supply chains. Then you've got these carbon or biodiversity offsets or credits. So in several regimes around the world, you have a mandatory biodiversity offset market that says for a given economic sector, you need to achieve no net loss of biodiversity. So if you harm biodiversity, you need to buy an offset somewhere else to offset your harm. And that is a driver of investment. It's actually a pretty large driver of investment in biodiversity conservation around the world. It's estimated that these national or state mandatory biodiversity offset markets generate around $12 billion a year of investment in nature. Now, contrast that, for example, with the international voluntary carbon market, and that is tiny. It's about $700 million a year. So these national or state nature markets, mandatory compliance markets, easily dwarf the international voluntary carbon market. And then you've got, the main source of funding for nature conservation is funding by the state for the generation of public goods on which the entirety of society relies. And so, the different forms of restoration that might be funded through these kind of mechanisms, they might include environmental measures within production landscapes like agroforestry. They might include active restoration, so that can include things like tree planting. That tends to be easier to commodify than natural regeneration, but simply because it's kind of easier to measure. So it's easier to measure in the specific commodification mechanisms that we use to give a value to nature. And then much less commonly, but we might fund natural regeneration as well. So just a very simple schematic, but this is just a very basic guide to why people might invest in ecosystem restoration and how they might do it. Now, one of the fun findings of my work, which I found very surprising, was I was expecting, I've done a lot of work on biodiversity offsets around the world over the last 7 years. And when I started this postdoc on biodiversity finance, I thought there was going to be a whole other world of financial instruments and things that I hadn't heard of. But it turns out that actually there's a real terminology issue in biodiversity and nature finance. I think the whole term biodiversity finance and nature finance is actually really misleading because it actually captures a whole load of things that conservationists like you or I wouldn't really recognize as nature finance or biodiversity finance. So this is a really interesting paper that was published a couple of years ago that went through the specific investments of a set of major investors who manage what they call nature-based solutions or nature investment funds. So what specific investments are the so-called nature funds investing in? Well, basically, what this report showed is that most existing nature-related investments are in established existing economic sectors that deliver well understood or attractive commercial returns. So we're not talking about investments in restoration that deliver the creation of credits or something like this. No, we're talking about sustainable agriculture and forestry. So most of what we call nature finance is actually just completely bog standard investment in sustainable agriculture or forestry. And most of what the private sector calls nature finance is actually just investment in ordinary market commodities that they claim have a kind of nature benefit. But that is not what you or I would recognize. So, the delivery of maybe sustainably certified plantation forestry, a conservationist might say that it's completely contextually specific whether or not that has a positive impact on nature. But in the context of the financial sector, that would be given the tick as something that is within the realm of a nature fund. So nature finance is a big umbrella term, and you need to go into the detail of the specific investments within nature finance to understand whether or not that thing is actually investing in nature restoration or not, because a lot of it isn't. There's also a huge amount of nature tech that gets labeled under this. So that's ways of measuring or monitoring biodiversity, which is not delivering biodiversity outcomes per se, but is delivering a commercial product which people buy, which is often buying better ways of monitoring biodiversity for the purpose of making better environmental impact assessments, for example. That would be considered nature tech, and that would also fit within these nature funds. Okay. Now, How does a nature market work in practice? Well, they're predominantly offset markets. So if we take the top panel, you've got some nature, you've got an area that's marked for develop for you've got an area that is ripe for potential restoration. So what you might do is a development might clear some nature away and pay for an offset on some area that could be restored. And that offset then creates a credit that allows that development to meet its liability, to claim that it's delivered no net loss of biodiversity, for example. So all of that process is just the process of organizing offsets. And you don't actually need finance or investment for this. You just need somebody to deliver an offset and somebody who wants to buy an offset. Where finance comes in, so finance is where the financial sector structures or invests in a project to enable that business to grow, basically, and deliver commercial products. Finance comes in if the offsets basically need to borrow money up front to deliver some kind of management measures that they then pay back investors over time through the sale of products. So in the bottom row there, a bank, for example, might lend money up front, or an asset manager might invest in a habitat bank, and they might basically provide a bunch of upfront capital. That Habitat Bank might go away, buy some land or lease some land from farmers, invest some of that money in generating ecological restoration, sell credits from that, and use that to pay investors back. So that's where investment fits into this picture. It's basically to provide upfront money for business plans that can generate a long-term source of income to pay back that investment, all right? Now, so that's how people can you can make money from nature. So the vast majority of it is actually the production of ordinary commodities, and this very small slice of it is from commodifying or creating tokens for the delivery of nature conservation or restoration outcomes per se, and those tend to be traded in offset markets. So that's how we do it. So now we're hitting on the main issue with these nature markets, which is a very interesting problem from economics, is the problem of adverse selection. So in nature markets, you are buying some kind of token that says that the environment has improved. How do we make sure that that thing is real? It's really tricky because of this problem of adverse selection, right? When you are buying the compensation of a harm or a loss that was inflicted elsewhere, it's exceptionally important that that thing that you've bought is actually improving nature, right? Because it's cancelling out an equal and opposite harm elsewhere. And if it's not improving nature as much as your harm is damaging nature, then nature overall gets worse. So it's really important that those tokens represent something real and additional. They represent something that wouldn't have happened anyway. So that's really critical. Now, what's the problem here? When I am a land manager and I'm faced with the decision to go into farming or going into delivering tokens for a biodiversity credit system, for example, right? I am much more likely to opt into delivering environmental credits if my so-called opportunity costs are low, if the kind of land management activities that I would have to implement to get these credits are as similar as possible to what I would have been doing anyway. So when people voluntarily opt into selling credits in nature markets, right, you are systematically attracting people who would have been doing something similar anyway. Right? And this is the fundamental problem of adverse selection. Now, this again, I said there's 30 years of evidence in nature market world. There is. Right? People have been doing nature markets since the 1990s. They started, ecological compensation has been around since the 1970s, and it started being transacted through market mechanisms in around the 1990s in the United States, around the 2000s in Australia, and it's kind of spread around the world from there. Now, ex post evaluation, so evaluations of the outcomes of these nature markets, have systematically detected huge non-additionality. This means that they have subsequently found that a lot of the specific nature restoration or conservation interventions that have been sold in these markets are for things that would have happened anyway. And there's one major exception to this, which is the US wetland mitigation banking system, which is an interesting result. But basically, that delivers largely additional wetland restoration that wouldn't have happened anyway, but still nowhere near enough to achieve its overall regulatory objective, which is no net loss of wetlands. So there has never been a nature market in history that has actually achieved its regulatory objective of no net loss of biodiversity, or carbon offsets that have actually offset the carbon that they've said they had. Right? That has not yet been recorded in the academic literature. There have been specific individual offsets that have been successful. So there's a really nice example of a massive offset for a huge mining project in Madagascar called Ambatovi, which was at the time basically the single largest ever foreign direct investment in Madagascar, I think. And that implemented a huge offset, and that offset has been shown to have offset more forest loss than was caused by the mine initially. So individual specific bespoke offsets have worked, but there has never yet been a nature market that has achieved its objective of either no net loss of biodiversity or has actually sequestered or prevented the release of as much carbon as it has claimed. But there's a huge variation in the performance of these instruments around the world. Okay, so previous offset market evaluations. Now, there is a big literature on evaluations of carbon offsets, which I'm not going to include here because that's been addressed elsewhere, and my specialism is in the biodiversity stuff. But the results broadly mimic these results. But there's basically, to date, there's been 5 evaluations of whether or not the nature conservation measures delivered through biodiversity markets actually worked or delivered additionality. And basically, the US wetland mitigation system did, but it still did not achieve its regulatory objective. It fell short by about 1,600 acres per year. The Devonish et al., that's the Ambatovi mine that I talked about, right? That offset is on track to prevent as much deforestation as it's caused. But basically, all of the other evaluations have demonstrated widespread non-additionality. So in New South Wales, that system seems to have been mostly protecting vegetation that would never have been cleared anyway. Sonta et al. Is a really strange result where it shows that the implementation of biodiversity compensation projects actually prevented the restoration of natural habitats, the passive restoration of natural habitats that would otherwise have occurred. So that nature market actually had an overall net negative impact rather than just a slightly weak positive impact. And then I'll show you how this kind of study works. But this is my own evaluation of that state nature market in Victoria in Australia. But basically, this is a pretty traditional impact evaluation framework. So we have all the shape files of offsets, and we use statistical matching to match them to shape files that are otherwise statistically identical, but not offsets. And what we've done is we've looked at the difference between the change in native vegetation cover before and after the implementation of offsets relative to their controls. Now, about 80% of that nature market is what we call avoided loss offsets. So that's offsets that are protecting existing areas of native vegetation, and they are claiming credits because they're claiming that if the offsets hadn't been implemented, that forest might have been cleared. And about 20% of the system is for forest regeneration. So they are implementing forest restoration on areas that have low forest cover to start with. And the aim of the offset system is to increase forest cover on areas that start with lower levels of forest cover. What this chart shows, basically, for the top panel is that 80% of the offset system that is protecting existing native vegetation, they did nothing. So they systematically protected forests that would not have been cleared anyway. There is no difference in woody vegetation loss, or there's no the difference in woody vegetation loss between offsets and controls. For the regeneration offsets, the picture is interesting and slightly more complicated. Basically, the native vegetation cover did go up in these offsets across the time horizon of the offset program, but so did vegetation across the entire state. And why did that happen? Because it just so happens that at the start of the offset program, the millennium drought ended, which was a 10-year major drought event in Victoria. And so at the end of this drought, you had a widespread restoration of vegetation across the entire state. So we saw an increase in vegetation in offsets, but we also saw an increase in vegetation in controls. And depending on the way you do the stats and depending on whether or not you exclude one major outlier, which burned to crisp in 2009, as a result of a huge, the Black Saturday fires, a major climatic event, then those offsets either did deliver some additional restoration that wouldn't have occurred anyway, or didn't. There's we don't have a sort of objective way of knowing which of those results is the right result. It's sort of a matter of interpretation. So what we know is that the majority of this offset system did nothing, and they might have caused a little bit of forest regeneration that would have otherwise occurred. But buried in this kind of analysis is the seeds of how you can design a scientifically credible nature market. So I find this very interesting. So yeah, for 47% of our offsets, there was no difference between offsets and controls, right? And each of these offsets should be outperforming their controls, but no difference means they did nothing. Controls outperformed offsets 22% of the time. So that means these offsets were actively harmful relative to controls. Offsets outperformed controls 30% of the time, which means those offsets were actually working. And for 7 offsets within the system, they worked really well. They prevented the loss of over 10% of the vegetation on the site. So buried into all of this variation, right, there's the seeds of how to design scientifically credible nature markets. If we can design nature markets that only allow those good offsets to opt in, but not the ones that don't do anything, right, then we might be able to design scientifically credible nature markets. So that's step one, the additionality of offsets. We've experienced widespread additionality failures in offsets. For the international voluntary carbon market, or REDD+, additionality is about 20%. So about 80% of carbon credits in the voluntary, of avoided deforestation carbon credits in the international voluntary carbon market are non-additional, and about 20% of them are additional. Okay, so step one, additionality. Step two, are we measuring the right things? So this is really important. If you are delivering no net loss in biodiversity is an infinitely complex multidimensional concept. The question is, what bit of biodiversity are you measuring? Now, I'm going to use England as the case study for this one. So in England, at the beginning of 2024, we introduced a new nature market. The idea is it's a new approach to land management. That means that every new development needs to leave biodiversity 10% better off than before the development was implemented. And this 10% is measured using a metric, it's what we call our statutory biodiversity metric. And it's an incredibly simplistic Excel spreadsheet. But basically, where a development is proposed, you look at the size of each habitat, you look at what kind of habitat it is, and you look at the condition of each bit of habitat. And you basically multiply all those things together and you get a biodiversity value. And there's a little bit of, it's not quite so simple, but that's the majority of the variation, is those key parameters. So then you get your baseline biodiversity value. Under this policy, what you need to do is you need to make sure that number goes up by 10%. And you do this by basically evaluating what you predict the biodiversity will look like in the future. And there are ways that the policy penalizes you for delivering riskier types of biodiversity in the future. So the idea is it's a kind of, there's a disincentive to clear valuable biodiversity at the start because it's quite expensive. You have to compensate with much larger area of habitat if you're restoring that type of habitat long in the future. Okay, so very simplistic metric. Basically look at the area of habitats and what kind of habitats they are. Now, notice, so that's a pure habitat-based measure of biodiversity. No wildlife in there at all, right? So what's actually happening under biodiversity net gain? There's a paper we published last year that tries to track the actual outcomes of biodiversity net gain for various irritating bureaucratic reasons. It is incredibly difficult to get this data. So this was an incredibly time-consuming process to go through various very opaque local government websites to get this data. We managed to do it for something like 150 developments. It covers an area of about 1,600 hectares. And so what you can see, the top chart is the trade, so the area of different habitat types before and after these developments have been implemented. And basically what you can see is that there's a huge reduction in cropland after the development. There's a huge reduction in modified grassland after development. That's conventionally just pasture. And there's a huge increase in built urban surface. So that's buildings. So basically, kind of as you'd predict, in a policy that is mediating land use change and permitting urban expansion. You're seeing urban expansion into croplands and pasture. But this thing is delivering a significant gain in biodiversity, actually a 23.5% improvement in biodiversity according to the Excel spreadsheet. Now, how it's doing this is basically, although the habitats are all getting smaller in the post-development scenario, there's a lot of promises that they will be better habitats of a higher condition level in the future. So basically, we're trading reductions in the size of green spaces, reductions in agricultural area today, in return for promises of smaller, higher condition habitats in the future. And the vast majority of these, actually, in our data set, 93% of them are actually within the built environment. So that means like if you build a housing development, we're talking about the promising high condition grasslands within the housing development itself. So that's the majority of biodiversity net gain is basically trading construction on farmland for for high quality grasslands within the built environment, within the development itself in the future. So that's the dynamics. Now, what's the problem here? Well, is that Excel spreadsheet actually a good measure of biodiversity? So, amazing PhD student who I supervise, Natalie Duffus, went out and spent 2 years actually sampling invertebrates, ground invertebrates in habitats that have been measured using this statutory biodiversity metric to work out if there is a relationship between real observed biodiversity measured via ground invertebrates and then processed using eDNA, and the metric that the English government uses to measure the biodiversity value. And what you see here is there's no relationship, actually. There's no correlation between independently observed wildlife or invertebrate abundance. The same result holds for richness. So there's no relationship between invertebrate abundance or richness and how valuable a site is according to the English biodiversity metric. So what does that tell us? If you organize a market to deliver the English biodiversity metric, you have absolutely no guarantee that that's actually going to improve wildlife because there's a mismatch between your proxy of biodiversity and real observed biodiversity. Okay, so we have some serious measurement issues in nature markets. We've got issues with additionality. We've got issues with dodgy proxies. There's a long discussion about counterfactuals and things as well, which I'm not going to go into. But this is a really important, the key takeaway. If your market's biodiversity proxy is not actually scientifically credible, this is a really big risk. Because what markets will do is they will basically harness a huge amount of innovation to deliver you the thing that achieves your objective at minimum cost or at maximum profitability, right? That's what a market will do. They will give you exactly what you incentivize them to do. So if your proxy, your ecological proxy, is actually not the thing that you want, you've got to be careful because your market's going to deliver you something that you don't really want. Right? So individual projects within these nature markets may well go beyond this and deliver really great benefits for nature. But what I'm telling you is the system as a whole won't. So you can't use an individual isolated case study as an example of something working or not. For a nature market, that you always have to take a system perspective. Is the market as a whole delivering its objective or not? Okay. So why are our metrics not working? Well, it's politics. It's actually because of this fundamental tension between how easy they are to use and how ecologically realistic they are, right? So I often get told when I present this work, Sophus, don't let the perfect be the enemy of the good. At least you have something. And I reply saying, what you're telling me is I should accept something that has an obviously exploitable structural weakness, right? That is not, I think there's a complete disconnect here. So you should be aware that whenever we introduce a biodiversity market, they are almost never introduced purely to optimize for biodiversity. They're nearly always introduced as part of the national planning framework to satisfy some kind of other competing political objective. So why is that important here? Because the metrics that we use in biodiversity markets so far have been oversimplistic, and that's so that they fit within the specific policy process that they're designed to work in. In England, this means they need to be implemented through one site assessment by an environmental assessor who doesn't have specialized expertise. So we've ended up with this Excel spreadsheet, and that's how the whole system works. And so if you made it more complicated, that system wouldn't work. You wouldn't be able to assess it in quite the same way using this relatively low levels of skill and capacity. And so you might make it more ecologically realistic, but it would no longer fit with the system that the market, the system that through which the market operates. So there's a fundamental tension, a trade-off, right, between the ease of use and the ecological realism. Okay, so that's if you pay for the thing, is it real? Now, the big issue, the one that I have the most fights with economists about, right? Can anyone check if you're delivering the thing or do anything about it if you're not? This is so important because even if you set up the theoretical ideal market, if you then study how it works in the real world, in practice, which is what I do, interviewing policymakers, interviewing people who are delivering these projects, and you try and work out how these things actually work on the ground, you can see that there's often a major mismatch between reality and theory. So compliance in these nature markets is very low. As I say, there's not yet been a nature market that has achieved its regulatory objectives. Some of them do something, but they don't achieve enough gain to achieve their regulatory objectives. And this is just a chart from a paper we published a few years ago that shows the compliance rates with various nature markets around the world. And the bar charts are basically meaningless because they all use different scales, because it's just bringing together literature from different papers. But what you can see is that compliance rates are never at 100%. They're often substantially lower. And in its most extreme result, in the bottom right there, you have this terrible, terrible result from Lucille Bezombes's work in Isère in France, where they have a biodiversity offset system. And it's not a market, but it's a sort of biodiversity offsetting compensation system. And there, Lucille Bezombes visited sites and the offsets only existed 70% of the time. So in 30% of the time, they didn't even exist. Right? That's a very low compliance rate, really problematic. Right? In England, in the English system, we've got very serious potential compliance problems. This is actually something to do with relatively specialized and detailed aspects of planning law. So I'm not going to go into detail, but the headline result is, remember what I said earlier, biodiversity net gain you can deliver through two mechanisms, either through ecological management measures within the built environment, or you can buy credits from the market. And basically, we have a whole set of institutions that manage both of these things. The credits via the market have much stricter institutions and much stricter regulations and governance than the credits delivered throughout the built environment. So what we've done in this paper is we've analyzed all of the units delivered in our sample in biodiversity net gain, and we basically worked out how many of these things are promises of higher condition habitats delivered in the future within the built environment. And we found that that's about a quarter of all of the policy. So about 25% of all the policy is stuff that's delivered in the future within the built environment. And this we categorize as of extremely low probability of compliance, because just as a quirk of the English planning system, basically these things, there's no governance for these things. So there is governance for some aspects of biodiversity net gain, but there's basically no governance for other aspects of biodiversity net gain. And so there's an extremely high risk of non-compliance. So we've traced this back to the individual workings of the planning system and legislation. So yeah, this summarizes a lot of what I was saying. In North America, the compliance in nature markets is that there's a very interesting system in North America where they mostly fund their habitat banks by selling credits up front. But this means that there's basically no money left for long-term management. So over half of all credits in the US wetland mitigation system are sold within the first 3 years of a project existing. And so when academics have visited sites 5 or 10 years later, they find that most of them are non-compliant because there's very little incentive for long-term ongoing management. If you make all your revenues up front, yeah, how can you hold somebody accountable for delivering long-term management? In Australia, we've seen this interesting, weird process where basically offsets were too politically complicated and too contested. So the way to get around this was, in that system, they literally kicked offsets further down the planning process so that they happened as a post-planning approval. So the planning, the developments would be approved based on based on the information submitted to the local authority, and on the assumption that they would have to find an appropriate offset. But that offset was not actually assessed as part of the planning process. It was a part of a post-planning process approval, which means there's obviously zero democratic oversight of those offsets, right? So they kicked the difficult decision over the offsets into a space where there's no governance, basically, or no oversight. So naturally, you mean that predisposes them to quite low compliance rates, right? Now, I've talked a lot about offsets, but there are other financial instruments for delivering nature conservation, like, for example, environmental impact bonds. These are not common, and the ones that exist, there's very few of them that work like a conventional bond. If you are interested in this, I can answer questions about this later. We're also writing a paper on environmental impact bonds. But what the key thing here is what I'm saying about these large-scale compliance failures or bad proxies in our nature markets, they also translate into other financial instruments. So there's some wonderful work by a colleague, Ben Thompson, who's gone into the specific key performance indicators underpinning some environmental impact bonds, and also found that those things are not measuring proxies that you or I would recognize as a biodiversity outcome, even though they're being categorized as a biodiversity outcome. All right. So how can you design a scientifically credible system, given all of the complexities that I've just thrown at you? Well, this is an attempt we did. So we published a paper last year that sketches out our ideas for how you can design a scientifically credible nature-based credit system. Basically, what we want to show that you can see this in the context of the international voluntary carbon market. This is our proposal basically for the international voluntary carbon market, but we make it a general case. So we say it applies to other kinds of markets as well, with some caveats. So basically what happens now is project proponents, they come up with a plan, they implement conservation measures, and the number of credits that they get is based on a kind of a project plan that they make, and often project proponents come up with their own counterfactual. So they come up with their own scenario of what would have happened anyway had the project not happened, and we kind of credit them the difference between what would have happened anyway and what they actually deliver. But what we see is that because of vested interests in the upfront crediting process and the determinant of your counterfactual, that there's huge mismatches. And so there's dramatic overcrediting, and these conservation projects are generally much less additional than they claim upfront. So then what happens is that lots of these credits don't have additionality. Some kind of ex post evaluation comes in and shows that lots of these credits are actually worthless, and then no investment flows into this industry, right? Because investors don't have confidence that it's actually delivering the products that they say it is. But here's our proposal for revolutionizing this system is basically to only release credits after they've already been proven to work using the kind of impact evaluation methods that I proposed earlier. Right? So by using statistical matching the actual change in forest cover in your offset sites relative to a statistically identical control, and only release those credits onto the market after they've already been proven to work, rather than based on some kind of upfront claims or anything like this. And there's a lot of complexities and a lot of thinking that's gone into this idea. But our idea is, once investors can see that every specific carbon credit is on average real, then investment might flow. When investors have confidence that their carbon credits are actually real, then we think that they suddenly become a much more appealing investment. So there's our idea. Only release credits after they've already been proven to work. All right. Now, what I've been doing for Superb for the last 3 years is talking to people. I've been doing a qualitative analysis of interviews and focus groups to understand biodiversity finance in Europe. So this is a paper that came out last month in Nature, Ecology and Evolution, called The Current State, Challenges and Opportunities for Upscaling Private Investment in Nature in Europe. And I've interviewed a lot of, basically like director or executive level biodiversity finance people in Europe and the UK, with a nice balance of investors, biodiversity finance knowledge institutions like consultancies, brokers and marketplaces that try and link up buyers and sellers, some project proponents, people who actually generate projects, And then I've asked them basically a semi-structured interview protocol. I've asked them a set of questions all about the challenges and opportunities for upscaling private investment. I've taken away all of that information, and then I've done qualitative data analysis on this, which is it's a thematic analysis, inductive thematic analysis. Pulled out all of the key themes from what people have told me from these interviews. So, what are the opportunities for upscaling private investment in nature in Europe? Well, there's a few. One that people talk about a lot is increasing specialized expertise, right? There's more people who understand both conservation and finance, so that's interesting. There's a lot of technological and financial innovation that is occurring quite rapidly to try and enable private investment in nature. So technological innovation includes like rapid real-time monitoring, for example, of biodiversity, something that means that you can measure biodiversity more easily, so it becomes easier to commodify. So people are quite excited by some of these technological advances, like pairing eDNA data with remote sensing. Right? There's a multi-dimensional real-time monitoring, basically, or ecoacoustics. Financial innovation. I spend a lot of time working in England's nature market, and I've been really blown away, actually, by the rate of financial and software innovation in that system to try and solve some of the problems to do with like lots of these things happen in nature markets are kind of crazy, and if you're not familiar with the specifics of like how the law works, I came fresh to all of this. I had to learn all of this stuff on the job. But like, a new market just comes into being, and then you have to write and design a whole new type of contract, right, to deliver this kind of stuff. It's very interesting. This becomes really complicated when the thing that you need to deliver is something you can't even really measure, like an intangible unit of nature. So you have to design a whole new kind of contract to deal with the delivery of an intangible unit of nature. Right? So you have to write a contract that says if you don't deliver this thing that you claim to measure in 10 years' time, then we can take this kind of legal action against you. And it's actually really complex. The whole system that almost ad hoc has to come up with a whole new set of institutions for managing this kind of stuff. So I've been quite blown away by some of that. There are some very interesting macroeconomic opportunities, especially facing farming in the EU. So this is one thing. Farming in the EU and in the UK is both unbelievably heavily subsidized and actually in most cases super unprofitable. And this means that there are a lot of land managers and farmers who are looking to diversify their income streams. And delivering credits through nature markets is one of the things that people naturally turn to as a way as something they hope to diversify into. And I mentioned some of the policy drivers earlier, like increasing disclosure frameworks and stuff that's all about trying to hold businesses to account for their impacts on nature and trying to encourage them to buy more products, basically, that deliver nature conservation goals. Now, of course, there's loads of fundamental tensions. Like, why hasn't private investment upscaled? Well, because there's still zillions of challenges to upscaling private investment. Like people are actually generally suspicious of it. So there's a social perception issue. There's loads of just fundamental differences between how finance works and how ecology works that I will go into in a later slide. But the really big one that is the elephant in the room that many ecologists don't realize is a thing, but has turned out to be like one of probably the most important and insight that I've come across in the last 3 years. It's also totally trivial to people who work in finance, right? So this is something that everyone in finance knows, but very few people in ecology know, which is that to attract investment, you need to be unbelievably profitable, right? Delivering environmental or nature market outcomes is a very risky investment. It's a very risky investment for lots of reasons. The main reason is that, you're not delivering a product, right, that somebody can hold or consumers can buy and feel, but you're basically selling the promise of some kind of environmental improvement. The value of that environmental improvement is completely determined by who will buy the thing. And in most cases, people are forced to buy the thing by some form of government regulation. So the value of an environmental credit, for example, is nearly always determined by some kind of government regulation. But lots of investors don't have confidence that government regulations will stick around. So they view environmental credits as extremely risky. if you want to attract an investor into an extremely risky investment, you need to offer them extremely high returns to compensate for the high risk that this specific product will not be delivered. So investors look for something that achieves what they call their hurdle rate, or a given risk return ratio. Something has to be, something has to be X% profitable before an investor will look at it for a given level of risk. Now, what's the problem? Nature markets are unbelievably risky. And so in order to attract mainstream private investment, they have to be incredibly profitable. So there is no direct analog for nature markets here. It's not published in the academic literature, but this is one study on biodiversity investments. Now, go back to the beginning of the talk. Biodiversity investment is actually a pretty nebulous thing. Lots of that are just sustainable commodities or commodity production. So this paper looked at the entire investment portfolio of a biodiversity-focused private equity firm, and it asked, how profitable do these things need to be before you'll invest in them? And what was the finding? 15%. So they need to deliver 15% per year returns. I don't know if any of you have a bank account, but if you've got a bank account, your current account is currently delivering you about 4%. And if you have ordinary stocks and shares, you're lucky over the last few years to have got 5%. Right? These things need to deliver 15% a year to attract private investment. Right? That puts them alongside, the kind of profitability of like US tech stocks. Right? At this level of risk, they need to be extremely profitable to attract private investment. Now, lots of governments then say, okay, we'll reduce the risk to investors through blended finance. We will de-risk these investments. So we'll underwrite some of the risks. And again, I can deal with this in the questions. It's a big subject area. But this does not get around the problem that a lot of these things just don't deliver very high revenues. So in this paper as well, they looked at the specific investments that were de-risked. What was the level of the internal rate of return, the rate of return that investors were willing to accept if government underwrote some of the risk for these investments? And it was still 12% per year. So still way higher than your current account. And that is even with government bearing some of the financial risk of the investment. So this is the big problem. You want mainstream investment to flow into nature, you need to make it as profitable as a US tech stock. And I just think that's insane. So some of the quotes from our analysis. I would consider us very risk tolerant investors, very in the grand scheme of things, and we're looking at things that others would definitely not look at. But even for us, so many of the projects we see it's just not clear where the revenues are going to come from. And that's a guy who leads one of the world's largest nature-based solutions investment funds, or a very senior public policymaker in a European development institution. Yeah, they just have easier ways of making money. So why would you invest in nature when you could invest in just an ordinary just an ordinary exchange traded fund that just trades ordinary stocks, right? So if you want to attract mainstream private investment, like the gap between where we are and where we need to be is immeasurable. And it's really arguable whether or not like a biodiversity commodity will ever get to that level. I'm going to skip this because I want time for questions. Now, there are different visions for the future, basically, about how we therefore fund biodiversity. The current prevailing political trend is to upscale private investment in nature through the creation of things like nature markets. Now, the state, public policy, can solve the nature finance gap in numerous ways. One thing they could do is just regulate activities more so that we do less damage to nature in the first place. That would bring down the cost of nature recovery, right? One thing they could do is just increase the amount of state spending on conservation, right? So we can deliver more public biodiversity conservation. That's something I would definitely advocate. A kind of alternative vision of the future is states say, nope, we're not doing conservation anymore. We're going to upscale private investment. And then states have to still invest a lot in building the fundamental institutions to upscale private investment. If you want to attract private investment, you need to make these things deliver 15% a year return. If you want these things to deliver 15% a year return, that means the state has to put in policies that give these things that kind of value. Otherwise, you won't attract private investment. So one of the findings of our paper is that public policy is both the enabler and the destroyer of nature markets. Right? It's really interesting. Like on one hand, they taketh, on giveth, on one hand, they taketh. So there's all sorts of tensions within public policy that underlie like why the upscaling initiative it conflicts with other public policy machinery. So there's these tensions between accessing land and preventing access of land. So this is interesting. So in some cases, we found that public money can't be used to buy land. So when conservation projects said we want to deliver nature commodities, and they were looking for co-financing, then public policy institutions said, no, we can't co-finance this because we can't help you buy land for nature conservation. So there's also interesting tensions within public policy. Investors want de-risking by government, so they want government to underwrite some of the risk of these investments. But one of the things they want to protect them from is the risk of that government policy changing itself, right? So governments are being asked to basically insulate investors from the risks caused by government's own policies, or investors' lack of certainty that government's own policies will continue to exist. So that is nuts, right? That's a public policy tension. And then this other issue of public policy coordination. So yeah, there's coordination between different kinds of public policies to make sure we get money into the right place. One of the main examples that came out here is CAP, right? So at the same time, so if you see nature-based solutions or delivering sort of nature credits as a decision that a land manager faces, then a land manager faces the various potential business models or revenue streams. Agricultural subsidies, right? So the public paying them to deliver agricultural commodities, or potential nature markets, right? But what people often don't realize is that means that public policy is basically competing with itself. Agricultural subsidies are public policy. They are payouts to farmers for delivering agricultural commodities and other public goods. So then if you want nature markets, you want land managers to deliver nature credits, then they need to be sufficiently profitable. They need to basically outcompete agricultural subsidies. So the more subsidy you give, the more you have to subsidize nature markets to compete with agricultural subsidies. So there's this kind of lack of coordination between different funding streams in the public domain that undermines basically enrollment in nature markets and stuff as well. Right? So they're all very interesting. So what I'm trying to say is there's this prevailing narrative across the EU and the UK that we can raise private investment in nature, and then the private sector can solve this financing gap, and that completely underestimates, in my view, that if you want investment in nature to scale, that is actually public policy. And it's the same kind of public policy as you would do if you were just doing direct conservation. You need public policy to create the markets that give nature conservation value, govern the markets to make sure that they actually deliver the stuff that they say they're doing. And then you need to even subsidize investors to even enter those markets in the first place, right? The role of the state in this is so enormous. So private investment in nature is actually misleading. It's actually just an extension of public policy. And an unresolved research question, therefore, is this more efficient, cost-effective, cheaper to the state, or scalable than just direct public investment? I am not at all convinced. And ultimately, it's an unresolved scientific question. So one thing that came up from my research is, this kind of question I want to leave everybody with, are nature markets kind of just like the performance of the illusion of keeping conservation off public budgets? Like they're kind of the illusion that, free money will come along. The private sector will invest in these things and that'll generate free money for delivering nature conservation. No, it doesn't work like that. If you want the private sector to invest in this stuff, you need to invest a huge amount of public money to make the private sector invest in this stuff. Okay, so at the end of my talk, huge thank you to Superb, and I owe a huge debt to the rest of my work package 4, and this is the team across Copenhagen, Oxford, and EFI. So what I want to take you to take away from this is, if you want to create nature markets that are scientifically credible in the 21st century, make sure the thing that you're buying is real. Make sure it's based on real data and not some Excel spreadsheet or artifact. And then, we would argue, actually, to be truly scientifically credible, you should only release credits after they've already been proven to work. Right? That's one thing. Now, make sure that if these nature markets actually don't deliver the thing that they promise, that you'd find out, and you have governance mechanisms in place to correct for that. And basically, we don't have that, right? So what we could do is design a nature market that has kind of basic monitoring in place to flag projects that are at a high risk of non-compliance. You need to make sure the nature markets are based on metrics that can actually be checked, right? And lots of nature markets aren't. So one of the reasons we can't do evaluations in several nature markets is because the data is all private. So then you can't check it. And then there's no way that the thing is going to work if nobody can hold it accountable. You need to make sure that the nature market administrators are sufficiently staffed so that they can actually do their job. And again, yeah, I can't say which, but I've worked with nature markets that employ a single person to oversee the entire nature market, right? So that's not enough. That's not enough to administer a multi-$100 million nature market. Then the question is it very profitable? Will people invest in this thing? So if you want private investors to invest in this stuff, you need to make delivering a given unit of nature worth something, and not only worth something, worth a lot. And if you want to make it worth a lot, then it has to satisfy some kind of need. There needs to be some kind of driver of demand, and that won't happen without regulation that upscales demand. Now, this means that governments need to continue a supportive policy environment, even when it becomes an economic constraint. That's really important. So if it's ever seen that these nature credits are becoming too expensive and they're holding back development, for example, then what we've seen historically is that governments have intervened to bring down the price of nature credits. But that, of course, undermines their credibility and it undermines their potential to generate cash flows. So all of these things are dependent on each other. And ultimately, I think one of the things that I've concluded is that there is an overwhelming policy discourse towards upscaling private investment. People don't realize how big the role of the state is in that vision. It's absolutely massive, arguably just as large as state-delivered conservation. And nature markets probably won't deliver very much investment because they don't satisfy the high levels of profitability required to attract mainstream investment. So I think we need to then unleash research, but also change the policy discourse around the limits to these markets. And we desperately need to supercharge research into non-market solutions for delivering environmental benefits, because these constraints are absolutely huge. You cannot, they are totally enormous, and it's super arguable whether even under favorable public policy decisions, these things will become profitable enough to attract mainstream investment. All right, so thank you so much for your time.
Thank you very much, Sophus. And despite the fact that you're speaking very fast, this was already an hour and a lot of input. So yeah, just in a nutshell, I've learned a lot of things. That biodiversity finance is a misleading concept, that additionality is very rare or rarely the case, that we are not measuring the right things. So I'm a bit demotivated, but in the end, there were some more positive notes on how we can actually do this, but even that sounds quite challenging, because there's this big gap between the finance people and also the conservationists on the other side. So I don't want to, I have a lot of questions actually, but I would like to prioritize the questions from the audience to really get them involved, and we can talk about my questions at another time. I will ask Shan to promote the people to panelists and see if this works. Okay, so we have a question from David, who is a colleague from our Spanish Superb demo, and you are invited to ask your question live now, David.
Thank you, Beshe, and thank you, Sophus, for the really nice. Can you hear me?
You need to speak a little louder. There might be something with your microphone.
Yeah, you're not on mute, but you need to get closer to your mic.
Okay. Can you hear me better now?
Yes.
Yeah, it's a little bit better. Yeah, if you speak at that volume, I can get you.
Okay, so I'm gonna basically just talk with my neighbors next to my wall, but it's good. It will be fine. Basically, the question is, how do you measure, and who is gonna measure the offsets? Because I mean, as the typical examples that we can have, for example, for the carbon credits, in the end, the one that can pay a lot of money for that credit is the one that decide what to do, and that's a huge risk. So, for example, I don't know, that's something that is happening, or well, you did the perfect example with the CAP, with the CAPA policy. Uh, in the end, the farmers are getting the money for promoting and for doing their job, but it is not necessarily right for the nature. For example, I'm gonna just put you an example that I think that is common for some countries. They are getting paid by land or for how much land they are able to manage. But it is not the point about how they manage it. So, for example, in order to control a bigger area of land, they just set fires in order to clear the land. But they are getting money because of that. So, as you mentioned in the end, and I absolutely agree with your conclusion, uh, just to put in the same sentence economy and nature, to me, that's the basic discussion more than the market itself. Because in the end, it's going to happen like, how do you measure the nature? Complicated. How do you transform nature in something profitable or like related with economy? I think that it shouldn't, but of course, something has to be done. So, and also the point of view of the measurements, like your example about the houses and like the transforming the house, like transforming the forest for building the house, as that was basically my question. You can have different point of views in order to measure it, just by the land that occupies the house, the how much carbon was able to sink the forest and now it isn't, or how much timber was able to produce that forest. The three offsets are going to be different, but they are all of them offsets. Which is the right point of view? Who has the right to decide which one are going to be the offsets?
Yeah, super. It's a great question. There's a lot in there.
Sorry for that.
So there's current practice, and then there's like my dream world. In current practice, different markets just measure this stuff in totally different ways. Every market basically measures something in their own way, and it's tailored to their specific local context. So, in the US, they predominantly look at the area of wetlands. That's their kind of outcome measure, and whether or not that area achieves certain performance standards. In the European forest carbon offsets, they all have their own methodologies for measuring the carbon value of those offsets. I'm more familiar with the UK's Woodland Carbon Code, which has got its own very specific methodologies with its strengths and weaknesses. So yeah, there is no correct way. One of the things that I'm kind of interested in at the moment is, can we define a way of measuring biodiversity that is actually in line with that specific jurisdiction's biodiversity goals? So I quite like this idea. So one of the projects that I'm doing right now is to try and work out, in England, we have spatial plans at the regional level that basically define what nature we want. We call these things the local nature recovery strategy. And I'm quite interested in how you design markets that are directly linked to those things. So the biodiversity outcomes delivers directly into that overall plan. So in theory, I quite like that idea. Now, what should we be measuring? There's actually no super good answer here. Where my thinking is, after thinking about lots of things, I've been through the whole journey of like, we should measure only stuff that's really ecologically realistic and detailed and have a super technocratic approach, through to, oh, I just can't handle it anymore, we should just measure area, and then now, yes, some stuff in between. I think if you're going to build a market, I've now come to the conclusion that if it's to have any credibility, that means we need to be able to measure the outcome variable using remote sensing data. Basically, that's the conclusion I've come to. So I think we should only be creating markets which you can validate. A third party could validate using remote sensing data. Remote sensing data is getting better. So basically, I think we can't yet design a scientifically credible biodiversity market because you can't really measure biodiversity using remote sensing. But I think we can design scientifically credible carbon markets today because you can measure carbon much more accurately with remote sensing. And then I would, so I actually think this is possible. I think it's measurable, quantifiable, and possible to design scientifically credible carbon markets when when your specific outcome variable, the thing that you're interested in, can be measured using remote sensing data. So forests is a really nice one. There are still some complexities around additionality and stuff in Europe because it doesn't quite work the same way as the kind of avoided tropical deforestation system that lots of these methods have been designed around. But somehow I feel like that is possible. And then I feel like as I think as science has a role to play here because I basically don't yet think that we can validate the biodiversity outcomes of a site from remote sensing, but there are a lot of people working on that problem, and we can start using proxies. Like we can start there are people deriving empirical relationships between things that are observable through, if not satellites, then at least LiDAR. So you can, 3D vegetation structure, for example, can correlate well with biodiversity. So soon, that level of technology will be sufficiently widely available that I think we might start being able to design scientifically credible biodiversity markets as well. But you can see the approach I'm coming from now is I now think the single most important thing, and I've been, after 8 years of thinking about this, I've been through many ways of thinking, but I now think the single most important thing is that somebody can check what you're doing. And so I think we should basically only be designing markets based on stuff that can be tracked using remote sensing because nothing else can be validated.
Thank you very much, Sophus. And that also links, of course, to costs because it can be quite expensive to do all the monitoring. And that adds another layer to it, obviously. But with the measurements and the monitoring comes the credibility and the transparency, obviously. I would like to invite Alina Leikonen from CPF to ask a question live.
Yeah, thanks so much. Thanks for the great presentation. It was very informative. I was just wondering, because I was also reading a paper of yours on this topic earlier today that mentioned that the expected price for would be just $12 per hectare per year by 2030. And then I was thinking about this adverse selection. So is there because that doesn't seem like a price that would also attract anyone to change their management, their land management. So is there a chance that with that kind of price, this adverse selection could still somehow be avoided? Or is there a chance that this price would be higher to actually avoid this adverse selection?
Okay, you have hit on an issue that we're literally just submitting a paper about this. It's a very exciting question. Here's a fundamental dynamic about markets that makes me mistrustful. In a voluntary market where sellers compete on price and buyers can't tell the difference between something that's good and bad, what you're doing is you're systematically incentivizing the people who can offer the lowest prices. And that means you're actively attracting the people who are most likely to be non-additional, right? That is a serious issue, right? Because they are the people who have the lowest opportunity cost. So there's this fundamental dynamic where offset markets are designed to try and attract the cheapest possible abatement, basically. But if you don't design your mechanism based on scientific credibility, that means that they might systematically, basically hoover up all the non-additional projects first because they're cheapest, and that's a really interesting thing. So the issue about prices, I think lots of the issues around prices go away once we're confident that your credit is actually scientifically credible. Once we're confident that your credit is scientifically credible, then all of those non-additional projects would never even enter your market in the first place, So that's and then if the prices become very high, then you need to start thinking about what the demand is. If your price of a carbon credit is extremely high and you don't need to buy one because there's no mandatory driver of demand, people just won't buy them because then it's too large a cost. So the only way this works, right, if you really think it all through, is if prices basically we only allow stuff that's scientifically, that's additional, so it's scientifically credible. That stuff will be more expensive because it forces out all the cheapest sources of abatement, which are non-additional. And then we need to force people to buy them through regulations and mandatory, we're talking about mandatory offsetting regulations or mandatory carbon neutrality regulations. That's the only way that all of those bits tie together. And then you've got all the politics, right? Then you've got the politics of how will the government intervene if businesses are basically faced with quite a large carbon tax, which is what the end goal of that system is, right? And that historically they've intervened by implementing measures that kind of reduce the prices. So that's how I think about your question. It's a really great question.
Thank you very much, Sophus, for the answer, and also to Alina for being so well prepared. Before we have another question from the panel, I would like to read out a question from the audience that is in the chat, in the Q&A, which is a bit kind of asking from the devil's advocate question. It comes from Daniela Goncalves, and she's asking regarding additionality. Isn't it a lot easier to gain 10% additionality for areas with very low baselines, like very few biodiversity, and then leading to the risk that mainly highly degraded areas are chosen for offset programs, because the 10% increase can be increased rather easy and cheap? And I think that's also something that is common, right? But maybe you have a response to that.
Oh yeah, no, it's a wonderful question. It's a common dynamic there. Yeah, so anything that's based on a percentage increase from a low baseline, you'll get a lot of credits for this. Yeah, common dynamic. No one's really solved this. Yes, it's easiest to demonstrate additionality there from a degraded baseline, because basically your statistical matching will just match on something else that's also degraded, there's a very strong land cover signal that comes from the recovery of something degraded, basically. So yeah, 100%. And yeah, you've hit upon one of the things that I find I'm most suspicious of markets about. Yeah. Markets need some kind of way of commodifying an improvement in nature. It's very hard to commodify basically like high quality nature that doesn't improve. Yeah? And so markets will tend towards commodifying clearly observable improvements in stuff, and we haven't yet really cracked how to create a market around preserving intact nature. When I normally give this talk, I say you need a mix of different mechanisms, right? I think markets can be used to basically deliver finance towards all the stuff that's easy to commodify, like restoration, and I see the absolutely irrefutable role of public finance being protecting all the stuff that can't be easily commodified. And I think like we should all campaign like hell if governments seek to reduce the funding for protected areas, intact natural areas, all this kind of stuff, because markets won't solve those problems, man. Markets will only solve this bit of the puzzle, and governments need to solve this bit of the puzzle. And there's no amount of rhetoric will overcome that barrier. So I see the role of markets as small, and public money needs to protect all of those intact natural areas because they can't be easily commodified. That's my opinion.
Thanks, Sophus. And actually the next question from Catherine van Stackelberg links exactly to that.
Yeah, thank you. So my sort of original question was, well, the usual question, which is, in a system where monetized profit is an imperative, how is it that we talk about natural capital on the balance sheet? Well, that's pretty easy. That's pretty straightforward. That we can do, but where is it on the income statement? So I have my own consulting company, and I'm also at Harvard, but I am doing some consulting for some small nature fintech companies, right? So I'll just give a sort of real example. So This is a little Estonian company, and it has the idea, it's a good idea actually, to connect real people with real, just small pieces of land. At COP15, people used to joke, oh, you're saving the planet 1 pixel at a time. Yeah, because so our fundamental, where we're starting is, it should be possible, right? In principle, we can actually monitor down to the pixel level vis-a-vis what you were just saying, remote sensing, and you can combine Earth observation, etc. But the market system actually rewards. So we built a digital twin is what I'm getting to. We're building a digital twin. But we should all be able to agree on what that digital twin looks like, right? And it takes a certain amount of energy and resources and etc. to generate the LiDAR, Sentinel, etc. And yeah, right now, the incentive is my digital twin is better than your digital twin, and you have to pay for it, and I'll give you this, and it'll be MRV, and it'll be verified, and it'll be fabulous. But in principle, it should be possible for us to all agree and to sort of monitor the planet at that pixel level. How you use it might be different, but shouldn't we be combining our resources to do that? That's one question. Secondly, though, is okay, so here's this little company, and we built our digital twin. It's based on peer-reviewed literature. We published some stuff in Frontiers, etc. It's for forests right now. And we got we went through Series A funding, seed funding. And what we find is that as we built this platform that connects ordinary landowners, we compensate you essentially for not harvesting or timbering your land. We're going to pay you for the work that nature is doing instead of the other economic reward that you might get. And then we link on the other side to buyers, credits, could be, we're sort of issuing tokens because the fiat currency relationship could vary on the difference of what the company or the corporate or the biodiversity credit buyer is looking for, right? And so here we are in the middle, and the incentive is to give you as little as possible, but to get as much as possible from the buyer, and then we get the profit, you get the profit, everybody gets the profit, we pay back our funder and whatever. And nature hasn't necessarily actually really been improved. So we're struggling with that. We're struggling financially ourselves to keep ourselves going. And in our discussions, the back end of the house, which is the people who are doing the programming, who don't really understand the science, but we're doing the science. And the back end of the house is like, oh my gosh, but you can't onboard every single pixel on the planet, can you? I mean, that's what you're sort of saying is we have to do. And it's like, well, but if you're really going to save nature, that's what you have to do, like a nature-backed currency. So what if you said the profit, the monetized profits you get is actually based on your nature positive outcomes? So actually monetizing the value of the ecosystem service that you are preserving, which by the way also gets rid of additionality, because look at carbon. Where's the additionality in carbon? Your incentive is to tear down the old growth forest, use it for the commodity value, and then regrow to get the sequestration value, right? Like, so additionality is sort of this weird herring anyway. But anyway, to go back to the nature-backed currency, is that the only way this is going to work? Like, how is this actually going to work? And why aren't we combining forces? Why aren't we saying we should be able to build a digital twin? We can do it. We have the technology. Yeah, we're going to argue about the machine learning and this and that, but all of that takes energy, et cetera, that is itself causing the destruction of the nature that we're trying to save.
Thanks for your question, Catherine.
Great.
I'm curious to hear what Sophus has to respond.
Yeah, I mean, I'm not well qualified to answer, right? My expertise is the tiny little slice of this that is the nature markets. Yeah, it's not the first time I've heard about this idea of these nature-backed currencies, and I don't know anything about them. I'm sorry, but actually, I mean, it sounds like it's going to be very important over the next several decades. So it's something I should definitely upskill on. Yeah.
Thank you very much for the inspiration, and then we can follow up with you to learn a little more about your work. I do have a question from the chat still, which
I have to go very soon, Gesche. I'm
yes.
already late for my next thing.
Okay. Do you still have 2 minutes, or should we just wrap it up?
Yeah, let's do one more.
Okay, then I would like to ask the question from Kuhn from Landlife. What if not restoring biodiversity would eventually be very costly? Would that attract investors despite high failure risk?
Okay, so if not restoring it would become costly. Yeah, totally. That would change it. Anything that adds a kind of a revenue stream or a strong commercial motivation for doing this. So I can't quite visualize exactly what kind of regulation you'd be proposing. Like a regulation that says if you have some natural area and it's not improving, then you'll be fined, right? Then so anything that provides some kind of material financial impact on either a potential buyer or a foregone cost for a buyer, all of that can be commodified. Those are prerequisites on designing a financial mechanism. So yeah, that's a possibility, although I can't quite visualize what regulations could underpin that.
Yeah, it's something we could further explore. Thank you very much, Sophus. That was very insightful. I would like to ask my colleague Shan now to share the preview on the next forest restoration talk, which will be not related to finance, but related to actually the history of forest restoration in Europe and the evolution of forest restoration approaches in Europe, and also related goals and objectives and lessons learned. And we will have Katharina Lapin from BWF and Maitane from CTFC. And the talk will happen in a month from now. So stay tuned. And to you, Sophus, big thank you, and have a nice rest of the evening, and we'll catch up soon. And sorry for all the questions we didn't answer yet, but there were just too many. Bye-bye.